Have you ever looked at your budget, found a little extra money at the end of the month, and wondered if it's even worth investing? There is a widespread misconception that you need thousands of dollars, a degree in finance, or insider knowledge to start building wealth. Because of this, many people simply wait. They wait until they get a raise, or until they have a large lump sum saved up, and in the process, they lose out on their most valuable asset. Today, we are going to look at the exact mechanics of how to start investing with just $100 a month. We will break down the math, look at a realistic strategy, and outline a simple, logical path for beginners to build a strong financial foundation. Before we look at the exact steps, we need to establish a clear foundation. What does it actually mean to invest $100 a month? In simple terms, investing was just the process of using your money to buy assets that have the potential to grow in value over time, or pay you a consistent income. When you only have $100 to spare, time becomes the engine that drives your wealth. This happens because of a concept called compound interest. Compound interest is, essentially, earning interest on your interest. If your investments grow and you leave that growth in your account, your money begins to multiply on its own. In a moment, I'll show you exactly how this plays out with real numbers over a timeline. You will see clearly why starting early with a small amount almost always beats starting late with a large amount. But to make this work, we need a strategy that is simple, sustainable, and doesn't require you to constantly monitor the stock market. So, how do you actually invest exactly $100? If you were to buy shares of individual companies, $100 might not even be enough to buy a single share of some of the most well-known brands in the world. This is where broad market index funds and exchange-traded funds, or ETFs, become incredibly useful. An index fund is simply a basket of different investments. Instead of buying a piece of just one company, you buy a tiny piece of hundreds or even thousands of companies all at once. For example, an S&P 500 index fund holds small pieces of the 500 largest publicly traded companies in the United States. When you buy into this fund, your $100 is automatically spread across all 500 companies. This provides instant diversification, which is a fundamental way to manage and reduce risk. If one company in that basket struggles, you still have 499 others holding your investment steady. To buy these funds, you need to open a brokerage account. Think of a brokerage as a specialized bank account designed to hold investments rather than cash. Many modern brokerages have removed account minimums and trading fees entirely. More importantly for our strategy, they offer a feature called fractional shares. Fractional shares allow you to buy a slice of an ETF based on a dollar amount rather than having to buy a whole, complete share. So, if one share of a broad market ETF costs $400, your $100 will simply buy you 1/4 of that share. This exact mechanism is what makes investing small, precise amounts mathematically and practically possible today. Once your account is open, the most effective way to deploy your $100 is through a strategy called dollar cost averaging. This simply means investing your $100 at regular intervals, like the first of every month regardless of what the stock market is doing. If the market is up, your $100 buys slightly fewer fractional shares. If the market drops, your $100 goes further and buys more shares at a lower price. This removes the emotional burden of trying to guess the best time to invest. You simply automate the transfer and let the math work. Let's look at the numbers to see exactly why this matters over the long term. Imagine you invest $100 on the first of every month. For this example, we will assume an average annual return of 7%. This is a realistic, historically grounded assumption for the broader stock market after adjusting for inflation. After 10 years of investing $100 a month, you will have contributed $12,000 of your own money. However, because of compound growth, your account balance would be roughly $17,300. At the 10-year mark, the growth is helpful, but the true power of compounding accelerates later. Let's extend the timeline. If you maintain this discipline for 20 years, you will have contributed $24,000 out of pocket. But your account would have grown to over $52,000. And if you keep this $100 a month habit going for 30 years, you will have contributed $36,000. But your portfolio would be worth roughly $122,000. That is over $86,000 of pure growth generated entirely by the market, just from a $100 monthly commitment. This clearly illustrates why time in the market is far more important than trying to time the market. The primary benefit of this approach is its low barrier to entry. you likely don't need to drastically alter your lifestyle to find $100 a month. It might mean auditing your subscriptions or cutting out a few discretionary purchases, but it won't deeply impact your standard of living. Another major benefit is psychological. By starting small, you build the fundamental habit of investing. You learn how it feels to see your account balance fluctuate without the panic that might come from risking your life savings. When you start with $100, you are building emotional discipline. Later in life, if your income grows and you are able to invest $500 or $1,000 a month, you will already have the infrastructure, the habit, and the mindset in place to handle it responsibly. Now, let's be objective and talk about who should hold off on this strategy. Investing is not always the correct first step. If you have high-interest consumer debt, such as a credit card balance with a 20% interest rate, you should not be investing your extra $100 in the stock market. Mathematically, it is highly unlikely you will earn a return in the market that outpaces the heavy interest draining from your credit card. Pay off the high-interest debt first. Eliminating a 20% interest rate is effectively a guaranteed 20% return on your money. Additionally, you should avoid investing your $100 if you do not have an emergency fund. Investing with the stock market is for long-term and ideally with the money you do not need for at least 5 years. The market goes up and down. If your car breaks down next month and you are forced to sell your investments to pay for the repair, you might be forced to sell at a loss during a market dip. Always build a cash buffer in a standard savings account before putting money into the market. For those who are ready to begin, there are a few common mistakes you must avoid. The first is checking your portfolio too often. When you invest in broad index funds for the long term, the daily market movements are irrelevant to you. Checking your account every day will only cause unnecessary stress. Review it once a quarter or even just once a year. The second mistake is trying to pick individual, speculative stocks with your $100. It can be tempting to search for a hidden company, hoping it will double your money overnight. That is speculation, not investing. For a beginner building a foundation, broad index funds are a much safer, more rational path. The final mistake is stopping your contributions when the economy struggles. Human nature tells us to run away from falling prices. But in investing, a market drop simply means assets are cheaper. If you stop your $100 automatic transfer during a recession, you are turning off the machine precisely when stocks are on sale. To summarize, starting your investing journey does not require a fortune. It simply requires a decision to start and the discipline to continue. By opening a standard brokerage account, utilizing fractional shares, and directing just $100 a month into a broadly diversified index fund, you lay the groundwork for long-term financial stability. This is not about getting rich quickly. It is about steady, methodical, rational growth. Focus on consistency. Ignore the daily noise of the market and let time and compound interest do the heavy lifting for you. If you are just getting started and want to make sure your finances are structured safely before you begin investing, understanding how to build a proper emergency fund is the most logical next step.